fellow Toastmasters and guests. Investing is really easy. You want the most gain with the least pain. That's all there is to it. How to achieve that is the difficult part. And we'll delve right into that now. Since the year 1900, the best return to investors has been from common stocks. Investors have earned, on average, 10% per year by investing in stocks. Investing in bonds, on the other hand, has returned about 6% per year. So you want to accumulate as much as you can, and you do that by investing in the stock market. Why is that so important? First of all, people live longer these days. Someone reaching the age of 65 now can expect to live until the age of 84. Life expectancy keeps going up. We want to accumulate as much as we can, and we want to take advantage of every opportunity that comes our way. The question is, how do you invest in common stock? When I started in the investment business in the 1970s, the way most people invested in the stock market was they would get a call from their friendly broker, like me, and would be told a good story. They would then buy that stock. A few months later, they would be called again and told a better story, buy that stock and sell the first one. Well, now everything is different. You can find your own stories. You don't need a broker. You go onto the internet, and there's plenty of stories out there. Many people own Apple or other stocks that are in the news quite a bit. What are the problems with buying and selling stocks this way? First of all, most people tend to be under-diversified. Research has shown that you need to own 30 to 50 stocks in order to diversify away the specific risks associated with each of those companies. For example, a company may have bad earnings, there may be surprises, and this can wreak havoc with your investment portfolio. Most people don't have the wherewithal to go out and buy 50 stocks or more. Secondly, people tend to overtrade. They buy and sell too frequently. Commissions have come way down since the 1970s, but there's a bid-ask spread. That's a large part of the transaction cost. Those have not disappeared. Most importantly, perhaps, is there are biases that influence people when they're buying and selling stocks. These are behavioral biases. There's what's called the disposition effect, whereby people will sell their winners too soon and hold on to their losers too long. There's also just the general effect that the emotions of fear and greed have on us all. People tend to get greedy when stocks are going up, and they'll buy, most often near the tops. They'll tend to sell when they get fearful and stocks are near their bottom. There are studies that have been conducted every year that show people underperform the market itself by at least 2% per year when they buy and sell stocks on their own. So what's the next level up in the hierarchy of investing? The next thing, the next way that people can invest in stocks is by buying portfolios of stocks themselves. Most commonly, these are mutual funds. Mutual funds have been around a long time. This is where a professional manager will go out and accumulate hundreds of stocks on your behalf. They'll charge a fee for this. Right now, the annual expense ratio for an actively managed mutual fund is about 1.2% per year. Now, what do you get for that 1.2% per year? You get diversification. Do you gain anything else? Not really. Studies have shown that actively managed mutual funds do no better than what are called index funds. That is the next level up in the hierarchy of investing. Index funds. These are non-managed portfolios of stocks that are put together to mirror an index usually, such as the S&P 500. You can go out and buy funds. There are mutual funds and there are exchange-traded funds that will allow you to own a broad range of stocks. And the fee for that is only about 0.5% per year. That's an enormous difference. 1.2%, 0.05%. People don't realize this. But over the course of investment lifetime, having an index fund versus having an actively managed fund, you can end up with 50% more capital when you're ready to retire, just by being in an index fund. This is why it's important to keep these costs in mind and to try to maximize your return. I've described now how one can achieve the most gain. As for the least pain, that's the subject of another talk. Or you can get my book. Thank you very much.